welcome back to the Everyday Growth Advisors, the EGA, where we teach you how to simplify financial education. Happy Sunday from wherever you're watching, if you're watching on the Sunday. And welcome back to the second video. If you haven't already, please like and subscribe to my channel so you get notifications for the next videos, and stay tuned. I'm planning to release a video every week, and hopefully over a month from now we'll have gone into some really juicy material. So continuing where we left off from last week, we were discussing passive and active strategies, how to start your journey of trading or investing, and to just give you a overall view on how things look like from that perspective. So we are going to continue on with the passive investment strategy today, and of course, before jumping in, we're going to cover some important concepts to understand as a trader. One of the most important things that you will learn in finance when you're starting off, or as a trader that you need to learn, is going to be time value of money, which is what we're going to be covering first. And then later, as we go along, and I've already received requests from you guys, and I hear you. I too want to get into the juicy stuff, like options trading, hedging, risk management, technical analysis. Those are all great things that I will be covering in the future, believe me. But let's learn to walk before we run, and just once we get passive investments and passive strategies out of the way, it will be a clear road down for the main event. So just to get your creative juices flowing, and to get you to try to think critically here, let's play out a scenario. Say that today you won a Powerball lottery, or whichever lottery of your choice, and you came with the first prize where you won $3 million. You now have a choice to make, which is going to be, the first choice would be take $2 million, so at a discount, and I'll explain why it's at a discount later. And you got to take it right now, and that's going to be your winnings, and you pay your taxes on it or whatever. And then the second choice is you accept an annuity, which is a stream of equal payments over a long period of time, but they pay you for $8,000 for 30 years. So every month you get $8,000 for 30 years, and you pay taxes whenever it's due. So from an investor's perspective, what do you think is the best choice? I want you to pause the video and take a little bit of time, maybe even use a calculator, calculate things and see which one you think you would choose. Cool. And if you did do the calculation, then you would come to a conclusion that there are these two outcomes. So if you took $2 million upfront right now, and you invested it into the S&P 500, which is an index that tracks the 500 top companies in the United States of America. And let's say we assume that we know that the US stock market has a 10% return per year over the past 30 years, right? Well, using a compounding method, you would have a total of $34,900,000. However, if you took the annuity, right, you would end up, if you did some basic math, you would end up with 8,000 times 12 months times 30 years. That gives you 2.8 million. Well, that's clearly higher than the first choice, right? Because you were ready to take 2 million, but then if you calculate how much your returns are over 30 years, that's 2.8. So, but is it really more though? That's the question. Because let's say you invested that $8,000 into the same investment as choice number one over 30 years, but you did it in every month instead of taking the lump sum and investing it one time, you would have $18,242,000 at the end of 30 years, which means to say that that was almost a double return if you took the money up front and invested it. So this is an important concept. I want you to get your idea behind it, because money and compounding has a time aspect that is joint to it. It's a lot like how other scientific things have concepts attached to it, like space-time, right? Same thing. Money has a compounding nature, and time plays a very important variable. The earlier you start, the better your odds are of compounding at a higher rate. And case in point would be the link that I provided in the previous video on Buffett versus the hedge funds, right? And then there's also another aspect, which is the expense ratio of your investment, so the cost of your investment, and we'll get to that in a little while. So just think about how time plays a very important factor. The earlier you start, the better it is for you, and that's the reason why you have to take a certain urgency when you are dealing with investments. You have to start now versus later, and I cannot prove it better to you in a point better than an infographic. So here is one for all you visual people out there. So same concept put into a different visual way, okay? If you started with 10,000 at the age of 25, which is the green line, you would have a nice upward sloping return, where you would be compounding at, let's say, 10% per year, and this is what it would look like, right? And if you started with, let's say, the red line, right, 20,000, but at age 40, so almost 15 years later, well, guess what? You would also slope up, but you realize that, this is much later you're starting. So you would, even though it's a higher gradient, by you starting later, your investment in the compounding nature wouldn't be as great. And then, of course, if you started with 10,000 at the age of 35, well, look at the amount of time it takes for the return to compound and compound and compound and compound till your investment starts to finally have a steeper slope. So this is just to give you like an overview on, how it would look like if you started with a long investment. And then here are also important things that you should know. If you put all your money into ETFs, which are exchange traded funds, versus mutual funds. So what are those two, first of all, right? If you want to start off investing, you're going to have a lot of questions regarding these, because there are a lot of people out there that use mutual funds and then some that use ETFs. And people always say one is better than the other, but I'm going to tell you right now that this is the difference, and you can be the judge on what is the better one, but you're going to know for sure what is the better investment. So differences between exchange traded funds, which is ETFs, and mutual funds. ETFs are mainly passively managed. So there is a fund manager, and his job is to track the investment into an index. So for example, if the S&P 500 contains 500 large cap companies, he creates a fund where you can buy into that fund on a daily basis. It's traded on an exchange, and so that's the reason why the name is exchange traded fund, because you could buy it every day and the price changes live, like how a stock does. It's basically buying an entire small piece of the stock market, and it's usually tracking a market index. So there are various different types of ETFs. The S&P 500 is the most famous one, and it's the most bought ETF for long-term investments. And also, the risk tolerance can be adjusted based on which investment you're making. So there are ETFs for S&P 500. You could buy an ETF for maybe defense stocks or industrial stocks if you're looking at those. You can even buy an ETF for energy companies. You could buy an ETF for gold. You could buy an ETF for oil. There are many different things you can buy ETFs for. But the main thing that you need to keep in mind and makes a big difference is the expense ratio, which is usually less than 1%. And as I was explaining in the previous video, expense ratios make a big difference. When you are looking at an investment, you want to look at the cost of investment as well, because the higher the cost, the lesser returns you get over time. And because investments have a compounding nature, cost also has a compounding nature. So as your investment's making you money, you don't want to keep costs high. You want to keep them as low as possible, so that over a long period of time, you pay the least possible to maintain your investment. And ETFs are less in cost. So mutual funds are mainly actively managed, which means the portfolio manager is actively taking things out, putting things in. He could be having a fund that's 25% bonds, 35% stocks, and then 10% gold, 25% oil, right? He could have many different things in the portfolio, and it's a mix of investments, so different kinds. Of course, there are many different mutual funds and they do many different investments, but the main idea is it's tracked and owned by a portfolio manager who gives you possibly even a higher return than the S&P 500 or a regular ETF. However, the main difference here lies in the fact that the expense ratio is usually higher than in an ETF. So, for example, the case of Buffett versus a hedge fund manager, right? He took an investment in only the S&P 500 index, and the hedge fund manager had a portfolio with a mix of different things, right? And the main difference that drove the return at the end of the bet was the fact that one investment had a higher expense than the other investment. So during a period of great returns, even though the S&P 500 lagged in the aspect that maybe the mutual fund made 20 or 30% in 1 year, and then the S&P 500 made only 10% in that year, right? And then in the next year, when the market was down, the S&P 500 dipped 5%. But the mutual fund, because they're aggressively taking risk, maybe dipped 30%. And so that drawdown over there, plus the expense ratio, makes your long-term investment worth less. And so it eats up into your earnings. As you go on, you realize, wait a minute, even though I'm getting a higher return per year, this doesn't make sense at all. So the main thing here is the higher expense. You have to keep track of your expenses, and that is the main difference. The other thing about mutual funds is you can only buy them once a day at the end of the day when the NAV, which is the net asset value, is calculated. So you can't trade it on the open market like an ETF. You have to basically buy it at the end of the day. So just to kind of go through the S&P 500 returns over a long period of time, and I'm going to wrap this up just in the interest of keeping these videos as succinct as possible. Here is the historical returns of the S&P 500 and why I say this is the best investment. Oh, and by the way, the best two companies that do ETFs are Vanguard and SPDR, which is the State Street Global Advisors. The ticker symbol for the lowest expense ratios for these are going to be VOO for Vanguard, and SPDR will be SPY, which is SPY. And they are the lowest cost index funds that you can buy for ETF tracking the S&P 500 market. So going back to the historical returns, for the S&P 500, going back 88-year period, we have seen 60 years of winning and 28 years of losing. And you can see that there are periods of drawdown which are really large, and then periods of gains which are really large as well. But every single drawdown period has been a great opportunity to buy in. For example, here, here. Every time the market dipped, this was a great opportunity to buy in, because with every downtrend, there was an uptrend, a downtrend, uptrend, a downtrend, whoop, up there, and then down here, and then way up, and then down, up all the way. And right now, the S&P 500 is at all-time highs, and so every time, if you would have bought at a dip, you would have made a really great strategy. Now, I know what your question is going to be. So what if I buy in right now and the S&P 500 dips, right? How do you deal with that situation? Well, as an investor looking at a long-term perspective, those short-term dips don't cause turbulence for your portfolio. And it's because of a concept called dollar cost averaging. So every time there is a dip, you would buy more. And let's say that the market went up here, and let's say this is where we are right now, and it dips. Well, guess what? You could buy more at a cheaper discount, right? It's kind of like buying your favorite thing at a discount. So as long as you're adding onto your position every month and every year, you will forever be in an advantageous standpoint in the long run. And you're looking at a horizon of 20 years. These dips don't count and they don't matter, because there is no way that you can time the market. And it's inefficient to do so. I would argue to say that by timing the market, you would get yourself into a lot of trouble. Let's say you thought that a certain top was approaching, and you think this is the right time to wait, and then you would have waited, it would have gone down a little bit, and then you would have bought here up, and it went up again, and then it went all the way down again. So you can never time the market. What you can do is, if it goes down and you bought here and it goes up, okay, that's good, and then you come down again, you buy more, and then you just repeat the process and stay consistent. That is the main thing. So that kind of concludes our video of 2 lessons in passive investments. The idea is, just to give you a recap, is stay with the same investment, buy it consistently, and over a long period of time you will achieve a 10% return, which is a pretty good investment, a pretty good return for a diversified risk of that kind. And so we'll see you in the next video where we'll learn some more juicy stuff. If you haven't already, please like and subscribe to my videos so that you can get notified when I post a new one. I'm looking at releasing one maybe every week or twice a week now, and putting some great time into giving you guys great content. As time goes on, there will be additional videos on more exciting subjects, stuff like options trading and passive investment strategies that will take advantage of tax strategies, and then also portfolio management, risk management. Yeah, so lots of great stuff coming your way, and I hope you like it. Thank you, and have a great Sunday.